Hello, everybody, and thanks for joining us today. We'll do the intro shortly, but just going to leave a minute or so for everybody to settle in and join us. So very excited. We're going to have our markets outlook at the start of the year, and we've got some wonderful speaker from BMO today, Sadiq, who we'll introduce in just a moment. So everybody settle in. Hopefully, we've got food and lunch and your thinking cap on, and we're going to go through all things markets, which has been an interesting start to the year, an interesting last year, and seems like every week there's a new headline that throws everything for a loop. So it's been an interesting time on that side of things, and to make sense of it all, we'll have a really insightful chat with Sadiq, and we'll tease out what's going on and what we're seeing and how managers and portfolio analysts and basic equity teams are thinking about all this together. So that's what's on tap for today. We'll do a little bit of housekeeping, but before that, I'll introduce myself. So Erik, as you know, and from our team as well, we've got Per. You'll likely see on screen as well. So Per will be doing the questions and helping us with that. But Per, if you want to say a quick hello before we get to our disclaimers as we speak.
Hi, everybody. I want to just thank again the team from BMO for setting this up and Sadiq. And as we show this exciting disclaimer here, if you're having trouble sleeping, you can read this. And I want to thank everybody for joining us, either on this call or perhaps you're watching the recording of this call. But Sadiq is we're very lucky to have him join us, and it's pretty amazing. So back to you, Erik.
Wonderful. Thank you. So that's our team. You see us moving, you see us static. We've got Leah, who's helped put this all together, Joan, and Kashfi as well. Fun to know Kashfi is from Kenya, and she's been spending some time there with her family. So I know we've got a wonderful, diverse team, and very happy to be able to support you with every one of us. On the next slide here. Okay, so a few notes of housekeeping. We'll get to Sadiq. If you do have to jump off at any point, don't worry. We'll send the recording out as soon as it's available. And if you do have questions, we will be having a Q&A period at the end. So if something pops up, please use the chat or the questions feature below on Zoom. Pop it in, and we will get to it at the end of the presentation. So we do want this to be interactive. If something pops in mind, please do share that. And without further ado, very excited to have Sadiq Adatia from BMO Global Asset Management with us today. So Sadiq, Chief Investment Officer at BMO, helps on the portfolio construction side, has a really good wealth of knowledge in terms of overall strategy, what's going on in markets, and is here to help us kind of piece this all together and help make sense of what's going on in the markets. And it's been a very interesting year on that side of things. So, Sadiq, thank you so much for joining us today. And we're very excited to hear your wisdom and your intel and share what you have for us today.
Sounds good. Okay. Give me a minute. I'm just going to share my screen, and then you guys can let me know if you guys can see it. And I'm going to see if I can. Give me a second here.
Okay, we see some slides. I think I'll just go to full screen.
Swap. Yeah. Give me a second here.
And do a little swaparoo. There you go.
Looks like we're
all right. Can you guys see it?
Success.
Thumbs up.
Yeah, perfect. Okay. All right. We'll skip through that. So I thought before we get going on what we're seeing in markets and what we expect going forward, maybe we do a little quick recap of last year. And, as you just heard, it was an interesting year for sure. This is kind of what I would say is a key part of what was going on in my head last year. Lots of noise on tariffs, what was going on, trade wars, China, defense, deregulation, of course, all of that led to a lot of uncertainty. And given a lot of that uncertainty, it was quite surprising how well markets behaved last year. And so if we think about, equity markets first and foremost, we definitely see that last year was something different than the last few years, where U.S. was not the leading asset class. Really, Canada was at the top of that shelf. Emerging markets and international markets, all well north of 25%. And U.S., though still positive, was about half that return, and that was an interesting story as you start to see people diversify away from the U.S. side of it. Now, you'll hear from me a little later on that I wouldn't necessarily get rid of the U.S. going forward. I think you just want to look at different things within the U.S. marketplace compared to what we've seen in the past. In terms of growth and value, it was still a growth-dominated environment in the U.S. Growth almost doubled the U.S. value. So still the tech names still held up quite well and continue to dominate. And within large cap and small cap, you saw the same thing. Large cap continues to do well, despite small cap potentially looking to do well last year with deregulation, tax cuts, all of that. It just didn't translate into strong enough returns in the small cap space. I do think there's a better opportunity this year potentially, but I don't think I want to necessarily get rid of large cap, given that that still is where we still a lot of the growth and a lot of the investments continue to be playing out. In terms of sectors last year in the U.S. marketplace, what you see here is that communications, technology were still the drivers of performance last year. So think about the key names, whether it's NVIDIA or Microsoft, Google. Those are still the names that were where all the money was going into, where the CapEx spending continued to go through. And lagging behind were staples and real estate. And staples, you might think of that as a bit of a surprise because the fact that, when you think about, the markets moving higher up, the expectation is that consumers were spending. But the truth is consumers were still a little bit more constrained this year than, what we've seen over the last few years. And what they spent their money on was really on technology, things like ChatGPT, things that are tied to their experiences, and less so on, the traditional things that we're usually spending money on, whether they're discretionary or on the staple side. And then, when you think about the material sector, we've had a great year in Canada. We'll show you that in a second, driven by gold. Remember, the material sector in the U.S. is quite different in makeup than what we see in Canada. So therefore, you didn't see materials do quite as strongly as you saw in Canada. On that same theme, you can see that commodities as a whole did exceptionally well. Gold was by far the best performing, a commodity, up 64%, followed by copper. But then on the other hand, energy prices were down. Both Brent and WTI were down roughly about 20%. And there's a lot of headwinds still on the oil side. When you think about what is going on with supply and demand, you just saw recently things on Venezuela. So these are still headwinds that I think you're going to still see in the oil side. And it's going to kind of keep the lid on where oil prices go from here, outside of the rare shocks that you might see because of geopolitical risks. On gold and copper, I still think there's room here for us to go higher next year as well. And I'll walk you through some of the logic behind that as well. From a Canadian perspective, you can see that different than the US, the material sector was up well over 100%. And this is really driven by gold. And if you think about why TSX did really, really well last year, it is because of that material sector, but also financials as well. We had a good rebound back in a lot of the banks in Canada, strong dividend yields, good supporting performance and financials. And that really was a key driver of that. As you know, materials, financials, two of the biggest sectors in Canada. And then, if you look on the right-hand side there, you can see industrials and healthcare, not necessarily as big sectors in Canada, particularly healthcare, and not really, driving the TSX from that perspective. And then if you look at bonds, it was probably a quiet but a decent year on the bond market. Bonds definitely handily outperformed GICs and cash, but it was the higher yielding, kind of the riskier part of the market that did well. Emerging market debt at 8%, U.S. investment grade and U.S. high yield roughly around that 7% range. And then U.S. aggregate bonds outperformed Canadian aggregate bonds by about 3%. And that's a reversal of what you saw the previous few years where Canadian bonds outperforming U.S. I think part of this was the fact that early on we did see Canada cut rates faster, but the implication was that the U.S. probably had more room to cut rates, and we saw the U.S. bond market outperform Canada. So now let's look into what we expect, that plays out in 2026. And if you had seen us talk about this last year, we always look at 5 potential themes that will play out. And so when I think about the first theme, it's to remain bullish on equities. And despite the fact that we've had a couple of really, really strong years, this is still a year where I think you want to remain overweight equities. I'll walk you through each of the rationales behind this in a second. Second, the exposure to emerging markets. It's been underinvested for sure, but I think given the fact that the situation with China and the US is more amicable, this is where I think you see some upside potential continuing on, building off the momentum we saw last year. Third, diversify across sectors. And so as much as we still believe that technology does well, we think that it'll be time for catch-up for some of the other sectors within the marketplace, things like financials, for instance, or even particularly things like healthcare. Fourth, I think it's an opportunity look for yield. And though we think that markets are going to be higher this year, we don't think necessarily we're going to see as strong of returns as we saw last year. And therefore, dividend yield will make a bigger portion of total returns. And that including bonds and things like covered call strategies as well. And then lastly, I think you still want to invest in gold. Despite the strong run-up we've seen over the last couple of years, I think the backdrop still remains pretty strong. And not only from a reason of value added, but also from a protection perspective, in case we do see more turbulence and uncertainty in markets. So let me go a little bit deeper on each of these. First, remain bullish on equities. So I think you're going to get better returns out of equities than we see out of bonds or cash. So when you think about where my opportunity set is, I think it definitely leans towards the equity side. Second, I think there's greater transparency this year and less uncertainty regarding tariffs. So remember last year, going into the year, we didn't know what tariff situations were going to look like. And there were talks about 40 and 50% tariffs. But coming into this year, we know we're talking about the low teens on the tariff side. It's a lot easier for companies to navigate through that, a lot more easier for us to navigate and put through what our expectations might look like. So that's a better environment heading into the year. Third, there's been a big wealth impact that people have forgotten about. Those that have been invested in the equity markets have seen a very strong outperformance of the last few years, and that's increased their wealth. The fact that rates have been cut have also been beneficial. And then you add in the third part that just generally, when you think about people's jobs, there's been a lot of job security. They've seen salary increases. So overall, their wealth impact has been really, really good. And that means they'll continue to spend on the economy, and that should be bullish for equities. I think we're going to get a stronger than expected growth environment. Though we had seen a bit of a lag, at some parts of last year, I think heading into this year, we're going to see a better outcome than people are expecting. And then lastly, the big, beautiful bill. This should be quite bullish for consumers and for growth, but not only on the consumer side, but also for corporations. And I think when you'll think about that impact, the fact you have lower rates and you get this additional funding coming in through the big, beautiful bill, that should, again, allow consumers to continue to spend and, again, spur the economy. So we are slightly bullish on that. What that means is we're anywhere between 1 to 2.5% overweight equities heading into the year. Now, exposure to emerging markets, if you think about the last 5 years in particular, people have underinvested in emerging markets. People were worried about China and whether they should be investing in there. Was that even an investable market? Heading into last year, people were nervous about the tariff situation with US and China. But what we've got out of this is that this is an underinvested market. And so it has been not hitting the mark in terms of performance because people have been wary about it. But I think any positive catalyst now should provide a really strong upside. And last year was a good example of that. Once we got clarity a little bit more on the tariff side between US and China, that it wasn't China bending the knee to the US, we did see the strong outperformance in emerging markets. Second, I think the AI story is not going away. And though I said we should diversify in the US, I think in emerging markets, you're going to see continued AI boom from areas like Korea, Taiwan, and China. Think about what happened with DeepSeek as a good example in China in particular. So these are benefactors of that. And if you look at the China story in tech versus the US story, China hasn't gone one-to-one with the US on that front. And I think there's room for catch up there as well. The large population growth in India and China make those consumers very much going to be contributive to things going forward. I've been to China more recently. I'm actually heading off to India in a couple of weeks to dig a little bit deeper there as well. But I think the middle class in both those areas has continued to grow. And that's a good sign for an emerging economy starting to move in the right direction to become an emerged economy. And so this is another upside potential that I see in emerging markets. And then, I alluded to this earlier, China and U.S. relationships look a lot better than they've ever been. If you recall, before Trump took office, there was talks about 80% tariffs. We haven't got anything close to that. And, when we got to that situation in November where, the deadline was reaching, all that ended up happening was we punted it out for another year. Both economies have continued to enjoy better tariff situations than what was initially expected. So that also is a good positive momentum for emerging markets. And similar to the equities, we're about a +1, slightly bullish. Again, that means 1 to 2.5% overweight that exposure. If you look here, this is what I was alluding to earlier when we go deeper in emerging markets. You can see that South Korea has really benefited off there. Mexico has done well. And if you look at it, it's actually India that's lagged behind. And this is where I think why opportunity is pretty strong for India, given in some of the headwinds are now becoming some tailwinds, and we could see some positive momentum along the way. And then China's kind of in that middle category as well, but it is one of the strongest economies around the world. And if we can get, that momentum continuing on, I think you could see a really good upside movement across that region. The third area was diversify equity across sectors. So I think you're seeing a broader earnings story and not technology, and we saw that in Q4. And that is a good sign. If the markets go higher, having a broader earnings story and a broader sector movement allows more stability on that going forward. The tariff impact was lower than expected, and that's actually positive because it is particularly those areas that have the lower margins that would have got hurt more, because now that their tariff is minimal compared to what was expected, they can maintain some of those margins and therefore see some better upside going forward. Growth in many sectors could outperform in 2025. Things like healthcare, I think financials continue to look positive. The Fed should continue to cut rates this year as well, so that will help consumers continue to spend, and not just, again, on technology, but against the broader environment. And lastly, though all the talk on AI has been leaning towards technology, just think about that, not necessarily the AI spend, but the fact that AI is going to help a lot of these sectors improve and get more productive, utilize less people. That means that, again, those lower margin sectors will have the most to gain out of that, because if they can save, a little bit here, their margins improve dramatically, and therefore their upside can be a lot larger than people were expecting. So this, to me, is a good reason why you should be diversifying across sectors and not just be overly loaded on technology. Fourth one was looking for yield opportunities. Again, as I alluded, we're going to get a positive return, our expectation for markets this year, but I do think it won't be as strong as the last few years. And so total return now will have a bigger portion made up by dividends. And that means that looking for yield opportunities, whether it's in financials, other higher yielding areas, I think that's where I think, aligns with the previous view on diversifying across sectors. Next, I expect to see volatility continue this year, right? If early indications are anything, we've seen stuff going on in Venezuela. We've seen, again, things tied to what Trump might do on defense sectors or, with oil companies. So this can be a great cushion against higher volatility with getting a portion of that return coming out of yields. Next, when I think about the fact that bonds will likely have muted returns this year, we think that if you're going to have muted returns, where you're going to be looking for opportunities is in yielding bonds. And again, I think bonds also provide you with that cushion as well. So not only in the equity space, but I think in the bond space, you want to be looking for a bit of yield in this environment. And then lastly, stay invested in gold. When we think about this is a great hedge against uncertainty. And we've seen that time and time again. People look for gold as a great way to protect their portfolio. Second, central banks around the world are continuing to purchase their gold. So particularly, if you look at China, for example, or India, they're still buying a lot of gold. And that is a great story when I think about what is going on from a perspective of central banks and the momentum story along the way, because that's not tied to any fundamentals. That's just tied to a bit of uncertainty on people being worried about the U.S., the T-bills being a source of currency exposure. They want to diversify a bit of that, and gold gives them that opportunity. And then lastly, many people are expecting the U.S. dollar to weaken. I'm not sure we expected that weaken dramatically by any means, but gold is a hedge against the U.S. dollar weakening as well. So another way to protect your exposure outside Canada. So again, we're slightly bullish there. Again, 1 to 2.5% overweight on gold and precious metals. So what are potential key risks, as we think about that as well? The first to me is the AI bubble concerns. And notice I didn't say AI bubble because I don't think we're in a bubble, but it's just the fact that people have concerns over it. That could cause markets to gyrate a lot. And we've seen that in 2025. I think that continues in 2026. There's still concern on valuation. There's concern whether there's too much CapEx spend and it hasn't generated the right revenue or expenses. And then will this continue to be a source of coming out of cash flows or potentially out of debt? So I think that's not going to go away, and that will probably put some pressure on some valuations. Secondly, I highlighted this right at the first slide, the uncertainty part. I think this is going to continue. Is the Fed going to continue with rate cuts? Are we going to continue to see geopolitical risks like what we saw with Venezuela? And will we see company interference? Things like, will NVIDIA be able to continue to sell their chips to the U.S.? What goes on with dividends? Will defense companies be limited on what they can pay out their employees? And then, of course, what goes on with oil companies as well. Those are things that are not priced in, and they could have impacts on a sector, on a geography, and those are risks that are there as well. And then lastly, the consumer weakness. You've heard a lot of stories last year about consumer weakness. I think that what we're seeing is consumer weakening, but from a very good positioning. So I don't think we're seeing actual consumer weakness, but just a little bit of erosion of that consumer strength. But if we were to get that consumer weakness and we saw a lot of labor issues and pull back on spending, then I do think there's concern there, because that means then valuations do have to come down because the growth trajectory is not going to be meeting up to expectations. So let's move back into some other themes that we think about. So, do we want to remain overweight equities? And the answer to us is yes. Again, go back to that big, beautiful bill. That is quite bullish for U.S. consumers and for growth as well. So I think that's going to be a story that will help continue to keep the valuations at a higher level in the U.S. still to outperform. The AX CapEx should continue, and that should improve productivity. That is more so in the U.S. than anywhere in the world right now. And then third, I think the Fed continues to cut rates, and that again remains bullish for the U.S. market. When we think about the investor positioning, you can see that households have continued to buy more and more equities. And given the fact that over that period of time, we've seen equities do exceptionally well, this is increasing the wealth impact in the U.S. market in particular. And therefore, as we've seen higher exposure, higher returns, we're seeing higher wealth. And that increases the confidence, and that increases support for the U.S. market as well. U.S. rate expectations. Now, I will say that for sure we're seeing lower rate cut expectations going forward. And this chart shows you that. If you remember, roughly around August of last year, the expectation was 4 to 5 rate cuts. As we get to the end of this year and end of 2025, we're now looking at potentially 2 rate cuts. I think we would be more certain about 1 than we are about 2. But really, as long as inflation remains tame, we get changes on the Fed potentially. These are things that can help conduce a second rate cut. But I think the third is really going to require a concern on labor for us to get there. So there is still rate expectations of rate cuts that is still conducive to stimulus to the economy. Now, I alluded a little bit about the consumer side as one of the potential risks, but that I was less worried about it. Here's why. When we look on the left and the right side of both Canada and the US, you can see that, sure, we have seen a job growth market still in 21, 22, and 23, but a lot of that was tied to the job recovery of losses we saw in COVID. And since then, we are seeing slight increases in jobs. So we're still seeing job growth, but as you get right to the end of 2025, you can see that's really narrowed down quite a bit. And so the concern is, do we see a slowdown in job growth, and do we see an actual pickup of job losses? And this is where the market is confused. What I think is going on here is that we aren't going to see a massive amount of job losses, but we're also not going to see a massive amount of job growth, because going forward, if someone were to leave a firm, what the firms are doing are asking, can AI pick up that slack? And can that make the AI make everybody else more productive so they can pick up that additional slack? And the answer is yes to that. And that's why you're not going to see a lot of job growth going forward. But it hasn't got to the point yet where people are saying, well, I can trim my workforce by 20% today because I have AI. I don't think that's where we're at this stage. That might happen down in the future, but that's why I think job growth remains tame. But I also don't think you put a lot of pressure on consumers, because there's not a lot of pressure on job losses either. On the employment side, you are seeing employment in both Canada and US actually picking up. Canada got a little bit of decline in the job picture there, but it actually went back up just this month at 6.8, and the US is at 4.4. So we are seeing unemployment go up a little bit. But again, we're at a very low level compared to history, right? History is at 4 and 6%, in 2019. And we're a little bit higher than that in US and Canada. But again, we're still at a very low level typically. And therefore, I don't think you're going to see a lot of pressure coming out of the consumer side. And as I highlighted earlier, the job openings has declined. And that is really tied to the fact that people are just not adding to the workforce from that perspective. So that's something to keep an eye out for. This is probably most things that people will be watching carefully on, because how the consumer reacts and how the consumer deals with job losses or potential less job gains is going to be tied to how they spend, and that is a key part of the economy. Now, when it comes to Canada, we're neutral. The reason is there is a lot of uncertainty on Canada. First of all, think about the USMCA deal that's coming up. And, normally people call it, CUSMA. I actually call it USMCA because the fact it is the US dictating this. The US holds all the cards here. And I think a lot of companies are holding back on their investment until they see resolution or some clarity here, right? You're not going to invest in certain markets if you don't know what Canada's negotiating power is going to look like in those markets. The second thing is growth and employment do look a little subpar in Canada. And compared to the US in particular, we just don't see a lot of positivity there. Third, we're still expecting financials and precious metals still to do well. So that's why we're not bearish on Canada per se. And the valuations look attractive compared to other markets. And so there is potential upside here going forward. I think this is going to be a story that, for the first half of the year, people are a little bit worried about Canada and nervous about it. Even the Venezuela situation adds a little bit of negativity there, because Venezuelan oil is similar to Canadian oil. The US can get some out of the Venezuela. It needs a little less out of Canada. But the infrastructure in Venezuela is brutal, and it will take a few years for that to occur. So Canada will run through a bit of kind of uncertainty for the first half of the year. As we get through the USMCA, and I do think you'll be okay, that likely means that Canada starts to get some momentum after that. So that's where I think Canada potentially has some upside at that stage. From a vulnerability standpoint, it still is household debt. Canada is significantly higher than a lot of countries out there on household debt. And this chart shows you Canada and US. US has gone through a very deleveraging process here, whereas Canada remains elevated and continues to move higher up. It puts a lot of pressure on the consumers, especially if rate cuts don't continue to happen in Canada. And I don't think you're going to see that in Canada, because Canada's probably stop cutting rates unless the USMCA deal does not go in an ideal fashion. And then you can also see that debt service ratio is quite high as well. So interest rates have a bigger impact, obviously, in Canada than we see in the US. Now, on a currency standpoint, you can see that on the top, the Canadian dollar last year appreciated against the US by about 5%. The US actually depreciated more against other currencies, almost 9 to 10% last year. And so, there's been a lot of devaluation, and that's also impacted why the US underperformed, international and Canada from that perspective. However, I think as we go into this year, given the fact that for sure expect the Federal Reserve to cut more often in Canada, that should put some more pressure on the currency. But I don't think that the US is going to be a currency that's going to decline another 10% this year. I think it's going to hold up relatively okay. I think Canada gains a little bit of ground on it, but it's still the reserve currency. It's still the currency people go to when they have volatility, and we're going to get a lot of volatility. And I still think that despite the fact that we've seen people move away a little bit from the US, I think people will still buy the US, and that still means that they buy US currency along the way. So don't count out the US dollar, but maybe a slight weakness there from that perspective heading into this year. When I think about gold and oil, I talked a little bit about gold, but oil, has seen this decline. And so when you think about what is the rationale for oil and why don't we see it go higher up? I think there's still the issue of supply. OPEC has started to reduce supply, but there's still an excess supply here, and demand just hasn't kind of kept up with that. Key to that is China. China, to bounce back, requires it to buy more oil and push ahead on that. I think there's an opportunity that demand could catch up, but at this time, we are just not seeing a bit of that. And again, if we get more Venezuela oil out at some point, that also adds to the supply side. On the side of energy stocks did actually okay last year, despite oil being down. So there's a breakdown there between the fundamentals of the energy companies and where oil prices are at. And that, again, alludes me to the fact that energy stocks probably don't have as much upside this year as what we saw last year. And oil prices probably, outside of a few spikes because of geopolitical risk, still have some downside, and probably maybe stuck in this range for the foreseeable future. International equities, obviously had a great year last year, and you can see what drove that. It was all parts of the market were up almost over 20%, whether that's the UK, France, Germany, Italy, or Spain. But really, it was Italy and Spain that actually drove those markets higher up. Heading into this year, I think, Germany has a potential to kind of bounce back and do quite well. The PMIs for all regions look good except for France. France also has, a lot of political issues, but they're seeing that across the board. That's what gets me a bit nervous because as we've seen in other countries, geopolitical risks are a big issue. And if you see a lot of that going on, it has an impact of capital moving into those regions. Germany looks a lot better, but it's still in the early stages of this defense spending that we saw. And we have seen the performance defense stocks outpace what actually the underlying fundamentals should dictate. So if we see continued defense spending, that's great news, that will support it. But again, we have gone a little too far too fast. And so right now, we're being a little bit more bearish on international equities. We think we prefer US and international markets and even Canada over that for now, given the valuations look a little stretched. However, if we start to see fundamentals change a little bit here and we see some momentum pick back up, then I think there's an opportunity there. But for now, this is where we're tilting against and tilting towards some of the other economies out there. On the bond side, it's very interesting last year. What I show you here, these dots, and these dots are actually the Fed and Bank of Canada rate cuts. And you would have thought that as you got rate cuts, that yields would have gone down. But look at Canada, for instance. You had 4 rate cuts, and every time you see those rate cuts where yields were at, we ended up the year higher, despite 100 basis points of rate cuts in Canada and 75 basis points of rate cuts in the US. And every time we saw that occur, we didn't see much movement in the US yield curve. So that tells us that there's a breakdown here between fundamentals that are going forward here. I do think that we are going to see a little bit of decline in yields but we're going to see probably a steepening yield curve, which, by the way, is good for financials. But I think that the yield curve is unpredictable at the moment. So just tying it just to a interest rate cut scenario doesn't always translate into your lower yields. I think U.S. bonds continue to outperform Canadian bonds because the expectation is that we are going to see more cuts in the U.S. than Canada. And again, as I mentioned earlier, higher yielding bonds should outperform. We're not seeing a nervousness on economies or a worry about consumers per se. And so if that's the case, we should still see higher riskier and higher yielding bonds outperform T-bills on a going forward basis. And then I'll kind of end off here. This is our 5 lenses, which really is a summary of everything I highlighted in essence. But this is for 2026. So every month we do adjust this tactically based on new information that we've got along the way. I'll kind of walk you through it in an easy way of what each of these lenses mean. Lens 1 is really our risk on or risk off trade, right? So do we want to be overweight equities, bonds, or cash? Lens 2 is where do we want to be geographically on the equity side? Lens 3, we get into our fixed income exposure, obviously high yield, investment grade, etc. Lens 4 gets into style and factor exposures. Do we want to be value, growth, small cap, higher quality? And then lens 5 is how we're implementing this. Are we hedging the currency? Are we using commodities to get exposure along the way? And you can see at the bottom, the scale that we utilize is similar to what I talked to earlier when I was talking about the 5 themes. So if I walk through lens 1, we're bullish on equities. So a +2 here. So that means we're going to be 2.5 to 5% overweight equities. And that is important. You heard me talk about the +1 earlier. That really is for January heading into the year. We're tilting a little bit less. But I do think broader, you want to be really bullish on equities. And we take that from cash. I think cash is where we see an underperformance again this year. And so we like bonds over cash. We like equities over bonds. Geographic, again, as I alluded earlier, we're bullish on U.S. and we're bullish on emerging markets. We think we can see double-digit returns coming out of our emerging markets and close to double-digit returns out of the U.S. We're neutral on Canada, probably a little bit more bearish on the first half of the year, but potentially some upside in the second half. And then still nervous about international markets. Maybe the markets went too far ahead last year relative to their economy. Lens 3, we're not, tilting too much on, overweight on any particular region, but we do like credit and high yield and emerging market debt versus T-bills as an example. And we do like a little bit of the U.S. duration given the potential Fed rate cuts that we're expecting. In terms of style and factor exposures, we're not tilting towards value or growth, but we are dabbling a little bit in the small cap space. As I mentioned to you earlier, I think this might be the year we might get a little bit of upside from small cap. We're tilting towards yield still, again, dividends on that side. And then in lens 5, we're neutral on the Canadian dollar. Again, I do think the U.S. weakens a little bit, but not enough for us to take a big currency call this year. And then we're still tilted towards gold. We see upside potentially, continuation from more buying of gold, but also as a good defensive hedge against the economy as well. And then I thought I'd show you this. Obviously, you've got my outlook right now, but we update a lot of information on a regular basis. There's a lot of collateral that we put out, whether it's stories on AI with our global equity team and what we produce with our tech stuff, the commentaries regularly on our funds, to our monthly house view, that 5 lenses that we update and produce on a regular basis, to my This Week with Sadiq that we produce on a weekly basis as well, giving information and insights that transpired the past week and actionable things that we're doing as a result of that. And then you'll see us actually a lot on BNN, multimedia, whether it's the Global Mail articles that we put out. So again, we're always out there providing our thoughts and views so that you have a good insights along the way. With that, I'll pause there and see if there's any questions that I can answer.
All right, thanks, Sadiq. We do have a bunch of questions here. I'll start off with one, and then I think Eric will jump in. We'll take turns. We'll tag team. Um, one of the things people are asking about is the projection for the real estate market in Ontario and the GTA. Any thoughts on that front? I know that's top of mind for a lot of people.
Yeah, for sure. I mean, it's a big part of people's household wealth, right? I think the problem is that right now, consumers do have already a lot of debt. They're probably not getting a lot of rate relief coming out of Canada this year. And there is a possibility, though I don't think it'll happen, of a rate hike even in Canada. So that puts a pressure on mortgage rates. That puts pressure on consumers. And this is a big year for renewals as well. So those that, 5 years ago had done their rates, there's I think about 30 to 40% of the population that's renewing this year. And it's going to be a much higher rate, obviously, than they've had before. So that puts pressure on buyers, at this stage. So I don't think you're going to see a lot of upside here. I think we could see maybe a little bit of movement, but it won't be, bifurcated across regions. Areas like Montreal or Ottawa and even Calgary might do a little bit better. But Ontario, where we're seeing a lot of the impacts of tariffs, and even Vancouver, where we're seeing a lot of pullback there, we might still continue to see some weakness there.
Good stuff. So
Thanks.
maybe I'll jump in here. We have a lot of questions on Venezuela. I mean, naturally, that's come up quite recently. We touched upon it a little bit, but just interested in hearing your thoughts into how that move to Venezuela from the U.S. Impacts things maybe on the global side, but then also from a Canadian standpoint, and how you're thinking about that in terms of portfolios and equity allocations. So we start there anyway.
Yeah, it is a good question. So Venezuela has one of the largest oil supplies in the world. So you can understand why the U.S. has taken interest in that, as they want to continue to increase supply and lower oil prices for consumers, particularly heading into a midterm election where that's going to be important. The fact that they've done what they've done, adds some geopolitical risks out there across the board, because if it's Venezuela as one, who's next? Greenland on something else, or any other countries down the way. So everybody's watching this carefully from that standpoint. Now, Venezuela, despite having this world oil reserve, has very poor infrastructure, and to get that oil out of the ground requires a significant amount of investments that will take multi-years to do. On top of that, oil companies in the U.S. are not excited by it because they've been burnt there before and they've been owned billions of dollars from previous things. So, they want to get paid back for those billions of dollars. They want assurances, they want guarantees, and of course, legal, protection as well, which no one at the moment is willing to give. And you even saw that the oil companies were there, I think, over the weekend, and they highlighted that comment as well in particular. So there's a lot of worry from that perspective that even what's going on right now, that might not still translate to anything. From the perspective of Canada and Venezuela, they have the same heavy crude oil. So they're like for like from that perspective. And if the U.S. were to bring it in, it'd probably go more to the north, which is not where Canada sends their oils right now. So short term, probably not an impact. But if they do get more oil picking out of there, then they could potentially transport that or find ways to transport that to other parts of the U.S. China is the biggest buyer of Venezuela oil. So if U.S. picks up a lot of the current oil, then that's China that loses out on that. Canada then steps in and actually supports China from that perspective, which actually is not a bad thing. It opens up another market and continues to grow that going forward. So there are implications to Canada from the oil perspective, but I think this is a more of a geopolitical thing that we have to watch carefully, because it could have impacts on other economies out there as well. So I think short term, as you saw, not really a lot of movement on oil, because people don't think this is a game changer at the moment, and might have some consequences down the road.
Oh, good stuff. And then maybe just to follow up, as we're on the topic of resources, just your thoughts on kind of how Canada's been repositioning itself with regards to the recent investments that are being made in terms of, minerals, oils, and kind of making that a priority. And then maybe even the lens of China, Canada, that relationship. We talked about the U.S. and China. But yeah, your thoughts on that and how it's been going, and have we seen any short-term impacts, or is that more of a medium to long-term strategy?
Yeah, this is I think everybody around the world is trying to be less tied to the U.S. where possible.
Mhm.
I think Canada understands where its strengths are, which is obviously the energy side, and in gold and precious metals. And this is where what China's done as well. So I think there's an opportunity for us to continue to pivot a little bit more areas where we can have strong independence and some leverage potentially along the way, and partner with other countries that have things that we don't have, that are outside the U.S. Canada's exports actually came down last year from 77% of the U.S. to 72%. So we are starting to see a bit of that spreading of that export side of the business. We're never going to get down to like 30 or 20%. So this is, a big tanker that we're trying to slowly move around, and it's going to take some time. But I do like the idea of doing that. And I think this is where Carney might be beneficial, because remember, he came out of the UK, so he has some ties there. He seems to be more amicable with China as well. So I think there are things that can happen along the way. The one thing to remember is that we're going through this USMCA deal, and the US will want to have some sort of concessions there for sure. So our hands might be tied, this year as we go through those negotiations.
Good point. Nice. Thank you. Per?
Thanks. Yeah. Another one, you talked a little bit about gold. What about thoughts about silver and copper? Obviously we've seen a run up in the price of silver recently, and with all the energy infrastructure being built in the U.S., I'm expecting copper to also come in short supply.
Yeah, I think, silver, I think, has a beta today right now of greater than one on gold. So you're seeing that really take off. I think you see a similar situation in silver. It outperforms copper. There's a bit of supply issue potentially that has caused a movement up. So that I'm a little bit less positive on. I don't think it necessarily gives back a lot either, but I think there's tied more to some supply and demand potential scenarios there. But I do think that silver has more upside from here as well, but it is a higher beta than gold at the moment. So, if you expect volatility, silver might go a lot more up and down than gold will.
Yeah, it's an interesting thing where, with gold having become so expensive, silver in cultures where it's very important to gift gold, you're seeing silver being replacing gold as the gift, right? So that people can continue to gift precious metals, but to their family members or loved ones or whatever culturally they do. But yeah, it's interesting. So it's driving silver, I think. Yeah. I had one more question, Eric. Obviously, last night we saw Jerome Powell talking about potential criminal probe into him and the renovation of the Federal Reserve. From my standpoint, I'm not a huge fan of that. It'll mean less independence for the Federal Reserve in the short term, probably could mean lower interest rates, although Jerome Powell is done in May anyways. And so someone positive, someone Trump friendly will probably go in as a new Federal Reserve chair. But what do you think, Sadiq?
Yeah, I think this is a topic that's been on the agenda for the last, call it, 2 quarters. What I think about is, yes, we will see a more Trump-friendly Federal Reserve going forward. Will it lose its independence? I don't think so still, and the reason is that it is still made up of 12 Fed members, and if inflation is exceptionally high, no one's cutting rates, right? No matter who you are on that Fed. If employment is exceptionally bad, everybody's cutting rates, no matter who you are on that Fed. It is only if it's close, that if it's tilted towards more Trump supporters, do we get that cut towards the way the Fed that Trump would want. So again, you still need that one extra vote, the 7th vote, to take it over. And that's where I think where things would tilt. So, yes, it'll be less independent than it has historically, but I don't think you move the dial dramatically because you still have 12 members that vote. And because of that, I still think that the data will dictate generally what we do from here. And we won't see 4 rate cuts as an example, just because we've got a new Fed chair that's, coming from a Trump supporter.
Thank you.
Very good. I mean, we've covered a lot today. How about we finish with maybe a rapid fire couple questions and just give your quick thoughts on it, and then I'll pass it back over to Per to wrap up. So, okay, number one, where do you see the biggest risk that maybe isn't getting enough attention in today's market?
I still think it is the geopolitical stuff. I think people have not priced that in well. They never price it in. But I think there's going to be a lot of that this year.
Nice. Geopolitical. Okay. Conversely, where do you see opportunity or maybe unloved areas of the market right now?
Yeah, this goes back to emerging markets. I think when you
Yeah.
go within even emerging markets, Brazil's a good example of one that's had a great run. Some of the forgotten markets are where I think there's opportunities, and especially if the Trump tariff situation goes a lot more friendlier than expected within EM, I think there's upside potential coming through there.
Nice. Okay, I've got two more for you. What's the biggest behavioral mistake maybe investors are likely to make over the next year?
I think people keep looking at the market returns and say it must go down eventually, and that's not true. Just because markets are higher doesn't mean the next year the probability is lower on that side of it. It comes back to the earnings story, and I think that's where people have to keep an eye on. Because last year, the markets went higher up, it wasn't because multiples went up; it's because the earnings went up. The multiples actually stayed the same, and actually went down a little bit. So it didn't get more expensive last year. It actually was the earnings story that drove it.
Yeah, very nicely done. Okay, and the last one to finish off. So, if investors slash clients remember one thing heading into 2026, what would you say? What should that be?
Yeah, don't be surprised by volatility and pullbacks in markets. Those are normal courses of investing in markets. But think of those potentially as some good buying opportunities, especially if you got some bigger pullbacks, and stick to a broadening story, diversifying story as well.
I mean, I think that wraps it up very well.
I got one
Sadiq.
more rapid fire
Yeah, go ahead,
question
Per.
for you. It's a two-part question. First question, football or American football?
Football for sure. NFL all the way.
Okay, so American football. All right. And your prediction for Super Bowl, who's in the Super Bowl and who wins?
This is going to be a tough one.
Yeah. Bills is the
I
right
actually
answer,
think
by the way.
I think it's going to be the Bills and the 49ers, and I think the
Okay.
49ers actually win this. And this is probably not what I would have said it at the beginning of the year.
All right. Excellent. So listen, everybody, thank you for joining us. A lot of information. If you're on this call or if you're watching it through our YouTube, feel free to watch the recording, watch it again. Reach out to Erik, myself, or Jeff with any questions, and we're here to help. Again, thank you, Sadiq, for joining us and sharing your knowledge and expertise. Thank you, Ashley, also from Bank of Montreal, for setting this up and supporting Erik and I and everything that we do. And thank you to Leah for organizing all of this and getting everybody on this call. A great job, everybody.
Yeah, thank you guys for inviting me, and thank you for your support. Appreciate it.
All right. Have an awesome day, and we'll talk soon. Go Bills.